Here we go. All right. So, good afternoon again, everyone. So, I'll just give a quick introduction when it comes to the idea or concept of diversification, particularly in the this thought process of what is alternative investments. Commonly, we think about gold when we think about alternative investments, and actually, there are a lot of different types of securities that we can invest in as retail investors. Now, obviously, for the big institutions, they can invest in a whole suite of instruments ranging from domestic to international. But just to orient some of you who might not be aware, so when we invest in the stock market, the stocks are actually called securities. So financial securities. Bonds are also a form of securities. So all these things that we invest in, they're called securities. Now, there are different types of financial instruments that we can get into as investors, and there are many ways of categorizing it. So here's one way of looking at it. So we'd like to call it the investment universe. And for a certain period of time, the investment universe was just pretty much static. But in the recent maybe decade and a half, with the progress in internet connectivity, with all the advancements in technology, microchip semiconductors that create more powerful devices, laptops, computers, the investment universe has pretty much expanded. So we have what we call the traditional investment. So that's on the right side. We have stocks, we have bonds. We're familiar with that. So stocks, whether it's domestic stocks, international stocks, bonds are either government securities or private sector bonds. And I'm sure many of you have noticed in the past maybe 10 years here in the Philippines, there's been an explosion of bonds available for us retail investors. So corporations have been catering more and more to retail investors for the bonds. And then there are alternative investments. We can break it down into two subcategories. So there's what you might call the modern alternative investments, things like hedge funds, managed futures, and distressed securities. And then there are traditional alternative investments. Some of these are familiar to many of you, things like real estate. So if you buy a piece of land, if you buy a condominium and you rent it out, that's a form of alternative investment, actually. And then we've all seen how in the past several months, there's been more and more attention on real estate investment trusts. So that's REITs. So when you invest in real estate, basically there are two ways to do it. Direct investment is when you yourself you buy the property. Indirect is when you do it through a REIT, the real estate investment trust. So both are under the category of alternative investments. And then there are commodities, things like oil, and then the topic later on, gold. For big institutions that are more adventurous, it could include things like silver, copper, oil, sometimes timber, etc. And then there are private equity investors. So the private equity investors are the ones who get into a business as an investor in the early stage. And then they hopefully get out through an IPO, for example, or some other way to dispose of their ownership. Now, here's another way of looking at it. So when we invest, we're actually looking for different assets to invest in. And there are different categories of assets. So we have stocks, we have bonds, we have cash. Cash is an asset, actually. It may not earn much if you leave it in a bank, but it's still an asset. And then there are alternatives. So you have alternatives like gold, art, real estate, hedge funds, cryptos, etc. Now, each asset class has its own characteristics when it comes to risk and return. Cash is obviously because it's cash, it's low risk, and the returns are very low. So here you might get 0.5% per year in savings account. You might get 2% a year in time deposits. So low risk, low return. Now, stocks, we're familiar with stocks, higher risk, higher returns, and it also depends on the quality of the stock. So the big blue chips have lower risk compared to the third liners, which have higher risk. So within the spectrum of stocks, you have lower risk stocks and you have higher risk stocks, and each one carries a corresponding low or high return. Now, bonds are pretty much in between stocks and cash. So we consider them medium risk and medium return. So bonds at its very core is nothing more than lending. So there's a borrower, there's a lender, and then the lending, that lending arrangement is contractually bounded between the lender and the borrower. So interest is a contractual obligation. In the event of liquidation, lenders get paid first and then owners get paid last. That's why it's medium risk and medium return. Now, the focus of our session this afternoon is the quadrant on the lower right, alternatives, wherein the risk and return varies according to the type of the alternative investment, according to the how familiar are people with it, and according to the technologies involved in it. Now, again, here's another perspective of that previous slide. So the risk and the return potentials for each of those asset classes. So stocks generally are viewed as higher risk. Bonds are moderate risk or medium. Cash is low risk. Alternatives are anywhere in between. So it varies. Now, the investment time horizon is important. For stocks, we're familiar. For building wealth through stocks, you need to have a very long-term horizon. So long-term typically means more than 10 years. So 10, 15, 20 years. That's for investment. Now, for traders, it's a different thing. Traders could be trading anywhere from 1 day to 3 weeks, maybe 4 weeks. So for long-term investing, you're looking at maybe more than 10 years for stocks. So that's wealth building. Potential returns are high. So when you hold it long term, you can expect stocks eventually to really go up. Bonds are somewhere in the middle. So you could hold it for 3 years, 5 years, maybe 2 years, maybe 7 years. So medium term horizon with moderate returns. Cash is low risk, low return. Typically, your time horizon for holding cash could be short term in the sense that you're just waiting for an opportunity to deploy the cash. So you're just on standby. You're waiting for the next chance to deploy your cash into stocks, bonds, or maybe alternatives. Now, for alternatives, the time horizon is typically long term, especially for things like timber, for example, because you have to wait more than a decade for it to become something valuable. So typically, the time horizon could be fairly long. The risk and returns, they vary depending on the nature of the asset. Now, we're familiar with gold, we're familiar with oil, we're familiar with things like silver as alternative investments, and obviously real estate. But as technology has evolved in the past decade or so, more and more, more and more instruments have been added to this thing called alternative investments. We're familiar with artworks, paintings, sculptures. We're familiar with wine, so we drink wine. But guess what? There are people who actually invest in wine in order to sell them again. So certain types of wine, they appreciate in value, and then you can sell them again. Timber, for example, a very long-term horizon. We're looking at more than a decade just to wait for the timber to become something worth valuable. And then there's jewelry. We're familiar with jewelry. So jewelry passed down from grandparents to your parents to you to your children, etc. And then a recent phenomenon over the past couple of years, NFTs, non-fungible tokens, getting more traction because of the blockchain technology. So we're familiar with cryptos, obviously, Bitcoin, Ethereum, etc. So NFTs are pretty much something building on the blockchain technology that's powering cryptos. And then there are various collectibles, things like coins, stamps, vintage cards, sneakers, trading cards. So things that we collected when we were little kids, it turns out they're worth something. They could be worth something as you grow older. So there. So those are the different types of alternative investments. Now, a few risks to keep in mind when you're thinking of dabbling into alternative investments. Obviously, there's a big risk when it comes to authenticity for things like artworks, for example, or coins, or stamps, or collectible trading cards. So there's a higher risk of fake items compared to traditional stocks and bonds. And then there's a big problem with liquidity risk for certain alternative investments. When you say liquidity risk, it's the risk of you not being able to sell your instrument at a good price when you want to sell it. Now, for stocks, we take liquidity risk for granted because the stock exchange is there. We can buy or sell the stocks anytime that we want. Now, for artworks, for example, a painting, it's difficult to buy, it's difficult to find a buyer if you want to sell a painting. It's difficult to find a painting that you want to buy at a good price. So that's called liquidity risk. So things like real estate, a condominium, a property, a stamp, a coin. So these things have liquidity risk. And then there's price risk. So it's sometimes difficult to establish a fair value. So what determines the value of a painting? Why should it be worth 200,000 pesos? Why not 250,000 pesos? So it's difficult to establish a fair value as compared to a stock which has an underlying business, which we can value using valuation models because of the revenue stream, because of the expenses, etc. So there could be a price risk. So what makes a sneaker valuable? What makes a stamp expensive? What makes a 70-year-old coin valuable or not? So that's price risk. How do you determine the value or the price of the instrument? Now, the key benefits are important, and these are probably the important things to keep in mind why considering alternative investments or securities are important. One of the important benefits is the low correlation with traditional stocks and bonds. Now, it doesn't mean that if the correlation is low, you should automatically load up on alternative investments because you have to consider the risk of these instruments. But one of the key benefits is the low correlation with traditional stocks and bonds. So what does that mean? Low correlation. If two things are correlated, they move together. So if stocks go up, another instrument will go up. If stocks go down, another instrument will go down. So they move together. Now, when you're building a portfolio, one of the things you'd like to accomplish is to diversify. When you diversify, what you should be thinking is if stocks go down, I need to have something that goes up. But on the flip side, if stocks go up, that something else could potentially go down. So they move in opposite directions. So that's what we call low correlation. Now you might be thinking, some of you might be thinking, why bother? Shouldn't it be the case that if stocks go up, I don't want something else dragging it down, my portfolio? But the reality is, we saw this last year, stocks could fall down unexpectedly. When that happens, you want to have something to offset stocks going down. So you want to have something that diversifies your portfolio to save you from something that's going down. You have something going up. Now, common alternative assets like gold, oil, and real property are good inflation hedges. So inflation hedge means that when inflation is going up or when inflation rate is going up, the price of gold, the price of oil, the price of real property, they also tend to go up. Now, one way of thinking about this is monetizing inflation. If you have alternatives like gold, oil, or real property, so we're familiar with real property. So, guess what? As inflation goes up, the value of your alternatives are also going up. In other words, you're monetizing inflation. So, for as long as you have these types of alternative assets, you're actually benefiting from inflation. Of course, some of your investments might be suffering, but your alternatives, your investments in these alternatives, is actually working in your favor if inflation is going up. Now, we've noticed, obviously, in the past several months, as the world economy reopens, the Philippines included, inflation has been picking up. And that's a topic for a different session. So inflation picking up, a variety of sources that's driving up inflation. So if you have alternative assets, you could be protecting your portfolio from the effects, from the negative effects of inflation. So those are the key benefits, low correlation, and it's a good inflation hedge. Now, when we say low correlation, here are some figures to help us visualize what low correlation means. So here in the bottom row over here, you have your gold, and Wait, I'll just get a pen over here. Yeah. So here you have gold, and on the upper row, you have the correlation with different types of securities. So for example, if we look at gold here, negative 0.13 versus US large cap stocks. That means gold has low correlation with US large cap stocks. And then negative zero point 0.7, that means it's a low correlation against US small cap stocks. 0.25 is the correlation with international developed stocks. 0.31 is the correlation with emerging market stocks. Now, when you say correlation, 1.0 is perfectly correlated. Negative 1.0 is negatively correlated. Zero point 0.0 is no correlation. So if you're closer to 1.0, you're approaching high correlation. If you're somewhere at 0, you're at no correlation. And if you're approaching negative 1, you're oppositely correlated. So you can see here across the lower row, gold has a correlation of close to 0 or negative with all the assets listed here on top. So that's what it means when you say that gold has low correlation with most traditional investments. Now here in the bottom, second to the bottom row, we have REITs, real estate investment trust. You can see that the correlations are generally fairly low, below 0.50 for most types of assets. So REITs, for the most part, represent real estate properties. So the correlation with stocks and bonds are also fairly low. So that's what it means when you say that alternative investments have low correlations. Now, there's not much data yet available about things like cryptocurrencies against all the other investment instruments or the artworks, partly because artworks don't have something like developed financial market for trading artworks. So it's for the most part private. Artworks are private. There's not much public data that we can use to compare against all these traditional investments. So again, when you say low correlation, this is what it means. So we're using gold here as an example, as a proxy for all the alternative instruments out there. Now to give you a better visual, oops, let me just remove all of this. Wait, your drawings there. All right. So wait, sorry, there, here. Now to wrap up my short introduction, um, here are a few slides to help you visualize what it means when you say low correlation. The yellow golden line is gold. The blue line, the that's I think that's light green. That's U.S. large cap stocks. So these are the real annual returns of gold versus US large cap stocks from 1985 to 2019. You can see that when the green line is up, the yellow line is down. When the yellow line is up, the green line is lower. That's what it means that they move in opposite directions. So this is gold against US large cap stocks. This one is gold against US small cap stocks. So the red line is US small cap stocks. Again, when the red line is up, gold is down. When gold is up, the red line is down. So they move in opposite directions. Same time period, 1985 to 2019. And then this one is international developed stocks, the purple line. Again, when purple line is up, gold is below. But when gold is going up, the purple line is lower. This one is emerging market stocks, the green line. So again, you can see the inverse or the low correlation. Green line up, yellow line down, yellow line up, green line lower. And then this one is all US bonds. So the light green is all US bonds. So yellow line low, green line up, green line lower, yellow line up. So they move in opposite directions. And then this one is international bonds. So you can see the disparity of the returns. Now, finally, here's another way of looking at it. So the return variation within the asset classes. So, for example, here on top, you have the emerging market stocks, wherein you have the range of returns running from negative 52% all the way until positive 71.5%. This is from 1985 to October 31 of last year. So for emerging market stocks, as low as negative 52% and a high of 71.5%. So that's a standard deviation of 28.8%. So that means it's high risk. So the range of possible returns is very wide with an average of around 12%. Then we have international developed stocks. So the range of returns is smaller than emerging market stocks. So negative 41 until 67.5%, a standard deviation of 21.6%. So the higher the standard deviation, the higher the risk of that instrument. Next is US small cap stocks. So negative 36% until positive 43% with an average of 9.1% and standard deviation 17.9%. REITs negative 37 until 33%, average 8.5%. US large cap stocks, similar. You have negative 37 and 34% with an average of 9.6%. And then here we have gold. There, gold has a smaller standard deviation of 14%. That means you have negative 29% until positive 26% only as compared that with emerging market stocks. So look at the range of values that you would have gotten during this 35-year period. And then US high yield bonds, all US bonds, international bonds, and finally T-bills. So pretty much this is where you would be visualizing alternative investments. So it's a way to hedge the volatility of some of the traditional investments. So not to say that you should load up on alternatives only, but it has a place in a portfolio to offset some of the risk in stocks, for example. So wait, there. All right. So that's it for my short introduction for alternative investments. So thank you for listening to this part. I'll turn it back to Ed so we can move to the next part.